Just over a decade ago, the government of Argentina defaulted on nearly 100 billion US dollars of its debt, the largest default in financial history. Today, after renegotiating that debt, just under 10% of the total, approximately 6.5 to 7 billion, of bondholders who did not accept the refinance negotiated in 2005 want the Argentine government to pay in full on the original bonds. 2 years ago, they began to sue the Argentine government to force the government to pay on its debts, whether the original bonds or the refinanced bonds. Just this past month, a judge in Manhattan, New York, held that the Argentines had to pay all the bondholders in equal measure. The problem, of course, is that the Argentine government is paying the holders of the refinanced bonds 35 cents of value of the original bonds. And if they were made to pay these funds that hold the majority of the bonds outside the deal, they would have to pay 100 cents on the dollar. So it's a big issue. It involves billions of dollars for the Argentine government. Today, the appeals court in the United States has held up carrying out the judge's orders because of some language in his decision that has vast implications for international bond dealings. The judge held that the Argentine government was equally obligated to all holders of its sovereign debt, whether those who had accepted the arrangement, the deal for refinance in 2005, or the hedge fund speculators known as vultures, the vulture funds, who are holding the original debt. Now, in his judgment, Judge Thomas Griesa of New York held that this should be true also of, quote, third parties, close quote, which is anybody else involved in the money market working of these funds. The appellate court argues that third parties is too vague. It could involve anybody in Europe. And with the Greek almost default hanging over the European market, this is a court decision of crucial importance to the entire bond market in the world. February, Judge Griesa will revisit his judgment, his decision, and try to clarify what he meant by third parties. Meanwhile, Argentina is effectively out of the international finance market because it is considered an unreliable debtor. Aside from the obvious implications for the European bond market, which is in turmoil thanks to the instability in Greece and Portugal, Ireland, and Spain, the implications of the judgment against Argentina are immediate and powerful for Argentina itself. In the past year, the government of Mrs. Cristina Fernandez de Kirchner renationalized the large petroleum industry known by its Spanish initials YPF. YPF has embarked upon an enormous and ambitious expansion project, for which it needs somewhere between 50 and 100 billion US dollars. The vast majority of that, over 90%, will come from foreign capital, either through joint ventures with international energy companies or on the financial market. Well, with this debate in which Argentina has not paid its bondholders, Argentina is effectively on the sidelines in the international money market. And with its, how shall we say, frivolous approach to public policy, the government of Mrs. Kirchner has effectively scared away all but the most speculative ventures in the energy industry. The energy industry in Argentina has had a very difficult relationship with private capital, going in and out of deals according to the short-term needs of public policy. As a consequence, foreign capital is not eager to flood into the country. The consequence, as far as Argentina is concerned, is that a country that has a surplus of energy, oil and gas, is now importing energy in order to satisfy domestic consumption. The costs of that politically and economically are literally unbearable. And the Argentine government, Mrs. Kirchner, will have to deal with this problem, and soon, if she is to maintain effective control over her government.